Welcome to Edgemoor Investment Advisors' video presentation of our first quarter 2025 market review and outlook. My name is Gay Truscott, and I am joined today by my colleague Steve LaRosa. The agenda for today's presentation mirrors the topics discussed in our quarterly newsletter, which can be found on our website, www.edgemoorinv.com. Here are the topics we will cover today. An April 2025 update, which we all know was about tariffs. Then a look back at the first quarter 2025 market review, when uncertainties first took hold. Then a discussion of the U.S. economy, resilient but with cracks emerging. Our portfolio implications and actions, Edgemoor's outlook and approach, and finally a review of selected securities. Let's get started. First, a review of the turbulent weeks at the beginning of April. Sweeping new U.S. tariffs were announced on April 2nd on nearly every nation with whom we trade and at levels which far exceeded market expectations. As you can see on this slide, these new tariffs are the highest ever levied since 1903, with an effective rate of 27% across the board. This policy shock roiled investors and caused a sharp sell-off in stocks globally, sending most major indices into or near bear market territory, which is defined as a fall of 20% or more from a recent high. And this occurred in just 4 trading days. We actually referenced a policy shock as a major risk in our last newsletter in January, but little did we know how prescient it would be. Since the initial shock, some of the tariffs have been paused, but uncertainties remain, and investor concerns are real. A prolonged tariff war could derail the economy by slowing economic growth, raising unemployment, and reigniting inflation. Adding to these worries, there has also been a sharp sell-off in the U.S. dollar and increased volatility in the U.S. Treasury market. We obviously don't know how things will play out from here, but we remain committed to our long-term investment strategy of constructing broadly diversified portfolios of stocks and income securities that we consider high quality and can weather periods of volatility. We also stand firm in our belief that good investments should not be sold at depressed prices. Now let's move back to a quick review of the first quarter that ended March 31st, even though that now feels like many moons ago. During the first quarter of 2025, the S&P 500 index posted a negative total return of 4.3% due to uncertainties about tariff and trade policies still to be announced. The negative return in the S&P 500 reversed 5 consecutive quarters of gains, as well as 2 consecutive years of 25% returns for the broad stock market index. The Nasdaq fell 10.5%, putting it in correction territory for the quarter, as tech stocks took the largest hits in the market sell-off. The bond market provided some relief to investors, with the Bloomberg Barclays Aggregate Bond Index returning a positive 2.8% for the quarter, as investors flocked to the safe haven of bonds, pushing up prices and pushing down yields. Remember that bond prices move in the opposite direction of interest rates or yields. As I mentioned, investors also rotated out of the growth-oriented technology stocks that had dominated market returns for much of the last 2 years. favoring instead more defensive dividend-paying stalwarts like utilities and consumer staples. It was the worst quarterly performance for tech stocks since 2020. The top performing sectors in Q1 were energy, healthcare, consumer staples, and utilities, sectors that had been largely left behind in the tech run-up of 2023 and 2024. Overall, of the 11 sectors that make up the S&P 500 index, 7 were actually positive for the quarter. 2 were essentially flat, and only 2, information technology and consumer discretionary, posted negative returns. So a key takeaway from this year's market is that diversification works. Well-diversified portfolios, like the one we construct for our Edgemoor clients, with exposure across industry sectors, market capitalizations, geographies, and asset classes, provide important ballast and protection for long-term portfolios. Now I will turn it over to Steve to talk about the U.S. economy, portfolio implications and actions, and our outlook.
Thank you, Gay. Looking at the U.S. economy currently, there are still positive aspects. Corporate earnings are still growing, consumer spending is still positive, and unemployment remains historically low at 4.2%. In addition, household balance sheets entered this period in good shape, and consumer debt remains under control. For example, as shown in this slide, household debt payments as a percentage of disposable income remain at the low end of historical levels over the past 25 years. Meanwhile, U.S. household net worth has been on a steady increase and reached a new all-time high of over $160 trillion as of the latest reading. The good news here is that the current tariff scare comes at a time when the balance sheets and liquidity of both households and businesses are remarkably healthy. However, the uncertainty created by the recent tariff policies is raising fears of an economic recession or potentially stagflation, which is the combination of stagnant growth and higher inflation. Since the president's tariff announcement on April 2nd, many Wall Street strategists have increased the probability of the U.S. entering a recession this year. It is important to keep in mind that the current economic situation is fluid, and recessions are impossible to predict with certainty. We recall late 2022, when 100% of Bloomberg economists, along with many others, predicted a recession in 2023 that never materialized. Ultimately, it will be the breadth, depth, and length of the tariffs that will be key to determining the short-term and long-term impact on the U.S. economy. It is also important to remember that historically, expansionary periods tend to last much longer than recessionary periods. And over the long term, stocks have managed to continue to make new highs through short-term slowdowns and even economic contractions. In the short term, we expect elevated volatility in global stock markets to continue given ongoing uncertainties. However, we also remain committed to our long-term strategy of constructing broadly diversified portfolios of high-quality stocks and income securities that can weather periods of market volatility. We also want to avoid selling good investments at depressed prices. In some select cases, we may take this opportunity to realize tax losses in certain accounts and repurchase those securities at a later date. Our outlook for the near term is guarded, as it is impossible to predict the outcome of the current tariff policy and its impact on the economy and markets. It is important to keep some perspective and remember that equity market volatility and pullbacks are a normal occurrence. Over the history of the stock market, corrections of 10% or more typically happen once or twice a year, on average. In addition, as a result of the current market sell-off, the overall valuation of the market has come down, improving the prospects for finding new, attractive investment opportunities. Even though markets can be volatile quarter to quarter and year to year, we emphasize to our clients the importance of sticking to a long-term investment plan focused on their specific goals and objectives. Now Gay and I are going to present our analysis of two securities that we own and are currently buying for clients. I will begin with an income security, American Electric Power, or AEP. American Electric Power operates one of the nation's largest regulated electric utilities that generates, transmits, and distributes reliable and affordable power to 5.6 million customers in 11 states, including fast-growing states such as Texas, Tennessee, and Virginia. As a regulated utility, the company enjoys the benefits of service territory monopolies and efficient scale advantages, which allow the company to invest in the growth of its business without the threat of competition. AEP recently announced a $54 billion capital investment plan focused on investments in its regulated business, transmission capacity, and renewable operations over the next 5 years. Other long-term tailwinds for growth include infrastructure-related spending, renewable energy advancements, and rising energy demand related to the increased use of artificial intelligence. AEP stock has performed well over the past year, and its dividend has grown at a steady pace of nearly 6% annually over the past decade, currently yielding an attractive 3.4%. And with a payout ratio of only 31% of its funds from operations, we believe AEP can continue growing its dividend in the future. I will now hand it over to Gay to discuss Visa.
Thanks, Steve. Visa, a familiar name to all, operates the largest electronic payments network in the world, connecting consumers, businesses, banks, and governments in nearly every type of financial transaction. Its core products include credit, debit, and prepaid cards, and it also operates one of the world's largest ATM networks. Visa is the #1 card network worldwide and processes roughly twice as many transactions as its closest competitor, MasterCard. In 2024, an average of nearly 830 million transactions per day were processed using Visa-branded products. Much of Visa's growth has been propelled by the increasing use of digital payments over cash transactions. More than 80% of the world's retail transactions are still conducted using cash or checks, leaving a long runway of growth for Visa as more payments shift to digital form. Visa's asset-light business model is attractive and produces high operating margins and high levels of free cash flow with modest debt. Visa's balance sheet is strong and carries a AA- debt rating from Standard & Poor's. In addition, management has proven to be shareholder-friendly, increasing its dividend by 18% annually over the past 10 years. Overall, Visa enjoys a dominant and defensible market position, strong brand equity, high returns on capital, and significant growth opportunities ahead. Visa has been a long-time holding of Edgemoor and has outperformed the S&P 500 index over 1, 3, 10, and 15 years. That's the kind of impressive long-term track record we like. This concludes our first quarter 2025 video presentation. We hope you have found it interesting and informative. Please reach out if you have any questions or comments. Otherwise, we hope you will tune in again next quarter.